Hi, my name is George Dagnino. I'm the editor of the Peter Duck Portfolio. I was looking at the S&P 500, and suddenly a pattern came very clear, and it's sort of simple, but I thought you may not have noticed it. So this is what this video is about. One point about charting, every time something grows at a constant rate and you plot it like most people do with what is called an arithmetic scale, eventually the curve goes up asymptotically. Okay, the way to plot over the long-term data is useful, not useful, it has to be done with semi-log axis. Like in this case, this is a semi-log axis. So in this way, when I plot the S&P 500, it becomes a straight line. Why is a straight line? Because the S&P 500 grows around 10% a year. So it's a constant rate on semi-log paper, you will have a straight line. Why is it important? Because this is how you can recognize this pattern. So let me show you now what the pattern is. When I look at a graph, I always like to draw two lines possibly, if possible, and it so that I include the patterns within a channel. And the channel is there is a lower line like this one, which connects this point here, then goes here, this point, and so on. Then you draw the parallel line like this one, and not coincidentally, it hits some points and some points here and closing at the lines of the channel. Now, why is channels are important? Because what they show you is that yes, the market goes, or in fact, you can apply the same concept to stocks. Yes, they grow at a given rate, like 10% in the case of the S&P 500. However, during this time, they reach periods of undersold, or overbought, undersold, overbought, undersold, overbought. What happens then when they reach an overbought condition, like in this case, like in this case, like in this case here, or this here, or here? If you notice, if you draw a line here for roughly 1.5 to 2 years, the market is not going to do much. You know that you have to wait 2 years for the market to go above the point where it hits the upper trend line. The same thing here. It hits here. It went roughly 2 years, but then before it get above this point, it took 2 years. The same thing here. It hits, became overbought, and it took all this time to go above this point. Here hit this trend line, and it took 2 years before it went above it. So what's happening now? Well, the market, according to this technique, is overbought. So it hit the upper trend line. So what does it mean? That the market is probably going to go up and down, be very volatile. For 1 or 2 years, it will trade within below this level, and then will eventually come up. So what happens here? You can expect the market to trade in a range, in a broad range, come down, come up, but you have to wait probably a year and a half before it goes above this level. Now, why this is important? Well, in my case, what I did, I said, look, you're facing a market volatility, so it probably is going to the market is not going to go anywhere. So buying and hold, try to find good stocks, good forever. You're not going to be successful. Which is why in my publication, what I decided to do is to go short term, trading between a month, 2 months max, and see if I can capture some value. But with the money mostly in cash, because at 4%, I'm sure I will outperform the market for the next year and a half. Well, just to remind you that we have three different levels of membership: videos only like this one, videos and financial updates, and then of course our research report with videos, model portfolio, and market updates. Again, as I said at the beginning, is a simple technique, but it gives you an idea of what I showed you of what kind of market you are going to face for the next, on average, year and a half. Well, thank you very much for watching. I hope to see you really soon. And again, to remind you that if you want to delve more into the details of our work, you can always go to www.patreon.com/Peter Deck.